Hello and welcome to FinTech Impact. I'm your host, Jason Pereira. Today I have Dave Carr-Pries, Vice President of Consulting Services at InvestorCom. InvestorCom has been on the podcast before, but I brought them back on the podcast to talk about how the implementation of CFR and Reg BI, both in Canada and the US, have basically panned out in the last year and where the successes and challenges are. And with that, here's my interview with David from InvestorCom. Dave, thanks for taking the time today.
Yeah, thanks, Jason. I'm glad to be here with you today.
So Dave, InvestorCom's been on before, but before we get started, just give everybody a refresher of what InvestorCom does.
You bet. So InvestorCom is a fintech company. We provide software really focusing on helping the industry make better financial decisions. And what that means, our focus is on compliance solutions that aim to make being compliant as intuitive as possible and removing friction and barriers from advisors and dealers.
Excellent. Reducing friction. God, there's enough of that in my life. Okay. So specifically, this is not a normal interview. InvestorCom's been on before. People can go back and listen to it, that episode. But this was specifically a conversation around the big changes that happened in regulation, both in Canada and the US in the last year. They both just happened to have the start date of January 1st of last year. And those two big changes were, of course, Reg BI in the US and the CFR client-focused reforms in Canada. Both had very similar requirements, but different, of course, two different domiciles. But nevertheless, they were big changes and they were big kind of increases in, let's call it onus to ensure suitability across the board. So talk to me about, first off, how you guys saw the challenge and how players in the market that you were servicing maybe saw it differently.
Yeah, well, I'd say there were really two major challenges that came out. The first one was a requirement to monitor for product changes. So how do changes in the environment and in the ecosystem affect suitability? So without an advisor or an investor doing anything, when fund companies change their products or things change about their products, suddenly a portfolio may become unsuitable. So that was kind of the one area. And the second one was a requirement for advisors to assess alternatives as they make recommendations with clients.
Excellent. So those are, when you start looking at the number of structured products out there, mutual funds, ETFs, alts, you name it, that is a substantial lift, right? Like there's a lot of product on the market. So basically, to me, this starts first and foremost as a data problem. So I'm sure you agree. Talk to me about how basically you went about trying to solve the problem.
Yeah, absolutely. And that's where we started with the data, because while it's a pretty obvious or clear regulatory statement about monitoring for significant change, no one really knew. So 3-4 years ago, when the regulatory journey began, no one really knew the size of that problem. They knew it was important. Yep. Saying you should look for significant changes, that's obvious. But how often does change happen? So back in 2019, we started digging through data, and it looked like there were over 2,000 changes a week in the Canadian mutual fund landscape. So that's where we started and said, there's no way on earth an advisor specifically, or even a dealer, can slog through that amount of changes and figure out what's material or what's relevant. If there's any kind of downstream suitability impact or whatever, that's just a daunting task. And
well, not only that, the question becomes, there's such a thing as a change and there's a material change, right? So like a ETF or whatever it is, dropping its MER by 1 basis point.
Right.
Is it material, right? Like I would argue it's not, right? A manager changing on a mutual fund or getting fired, that's a material change, right? Potentially. So it comes down to not only how do you take these 2,000 a week and screen and filter out the noise and look for the signal.
Right. And that's where the trend, both in Canada and the US, from a regulatory perspective, is to make these regulations principles-based. So you use the term material change. The regulators actually intentionally did not. They introduced a new word called significant change and left it up to the dealers to define it. So while the concept is well understood, how you bring it to life can vary from dealer to dealer.
And frankly, that doesn't surprise me because, the funny thing about regulation is everybody in the industry everybody except the regulators want it to be clearly delineated lines as to what can be done and what can't be done. And the regulators are like, no, because you're going to try to find the loopholes and sneak around that. So we're going to use principles, right? Because end of the day, you can definitely stay within the color within the lines, but you can violate the principles. So, which is funny because, just a side story, in conversations with dealers, it causes them no end of grief. Like, they should tell us exactly what to do. And my response is, no. That's technically your job. Your job is to take the principles and make sure you don't violate them and do it. What else? Yeah.
And that's where, our perspective tends to be, this actually opens a door for those dealers to self-define or really focus on, how do I want to interpret this differently in support of my business and my business practices? But to your point, the compliance officers, they would prefer hard and fast, really clear-cut criteria, definitions of what do I need to do? How do I get it done?
Yeah, I think that will be established over time as precedent sets the floor for what they expect to see. I mean, as the regulator, and I've seen this in conversations with them, as they go in, they're checking boxes right now and make sure you have something. Then they're going to start looking and make sure that something actually works well. Then they're going to see something that works really well and be like, that's how it should be. And then they're going to enforce to that.
Yeah, exactly. And so it's something that evolves over time. And unfortunately, there's a few bodies along the way, or sacrifices that are made as people made probably decisions that weren't good, or interpretations that the regulator won't agree to.
So fair enough. So you have 2,000 changes a week as an example coming into the marketplace. Basically, you have to look for significant changes. Talk to me about how you solved for that problem or attempted to coach them through solving that problem.
Yes. So, I mean, the first part was just involved in industry conversations about, especially in these structured and managed products, what are the kind of the data points or the elements that you look for significant change? And while there wasn't consensus, we kind of narrowed it down and said, all right, a few of the key data points that I'll say are less debatable, let's take a look at those. Does that narrow and reduce the scope? And it probably did. We looked at probably 4 key ones, which were measurements of kind of the CIFS category, which is just a standard way of how the fund is invested, a risk rating, a time horizon, and cost. MER, as much as it changes a lot, it's a measurement that you got to look at. Regulators are keenly focused on cost. And so that cut the amount of change to about a third, so about 850 a week, but that's still a lot. And again, that's at the dealer level. Mm-hmm. And ultimately, the reason you're monitoring, there's really 2. One is manage the products on your shelf. So that's clearly a dealer obligation. But the other one, which is probably more relevant, it's the downstream effect. So when a significant change happens, an advisor has a bunch of activity to do. It's not new activity, but it's the trigger to say, when this happens, now think about the suitability of a portfolio. Think about KYC, is that updated? Think about rebalancing or any change that need to happen with that client. And instead of doing it on your time, it's done based on a trigger in the industry and a product change. And so when you think of those 850 a week, again, at the advisor level, that's even a non-starter. And funny thing is, I had a conversation just a couple of months ago, and so this is a year into client-focused reforms, with a CCO of one of Canada's largest independent mutual fund dealers. And she didn't have a clue how many of those significant changes an average advisor would have to take action on in a typical year or a week. That's not new. I'm not kind of singling that out. That's because this kind of change management or change monitoring process, I mean, thanks to the regulators, kind of a new thing. So no one really knows what that magnitude is. And so again, to your point, we tackle this as a data problem, and having had a solution in the industry that's been creating this audit trail of industry change, we started doing some sampling this past summer.
But it's an interesting problem because it's like a filtering problem. And the question becomes, so for example, dealers serve a wide swath of advisors. So they have to be able to A, meet the standard, to B, provide the tool sets to make the wide swath of advisors' lives as easy as possible. However, the question becomes, how complicated is that each advisor made their life, right? I keep saying, people in this country, people are like complaining about all this work. And it's like, this is not hard. You need to have an investment thesis for how you actually manage portfolios, and you do it consistently. And then you just have to look for changes that are pertinent to that, right? Like it really is not rocket science. It's the science, and it's basic due diligence just being encapsulated in law for the first time, right? So I think there are, to me, I will say CFR was a near non-event in that the implementation, just change a couple of things in implementation, maybe document a couple of things a little more thoroughly. But to others I know who basically bought everything under the sun and hold God knows how many fund codes in their book, oof, what a burden. But I would argue that they shouldn't have been running their books that way in the first place.
Right. And some of the sampling we did, especially in, I'll say, firms that are open architecture, they have a large shelf, a lot of transfers in on advisors' books. When you looked at one advisor book to the next, they were probably more dissimilar than similar. So that task of saying, I now have a manageable amount of change at the advisor level, it's figuring that out. Because, I've got this at the deal level, but I've got to parcel out to each advisor the part that's meaningful to them. And what's meaningful to you won't be meaningful to me because our books are probably dissimilar.
Yep. All right. So you basically have helped them filter this out. Talk to me about the technology solutions you put in place. How have you done that?
Right. So we've taken our Shelf Monitor solution, which builds this industry audit trail, and added advisor alerts. So when we get in, advisor position data, we're now able to kick out weekly alert files to each individual advisor based on their positions and only their positions. And basically, it takes that 850 a week at the dealer level to probably about 250, 260 changes a year for an advisor to manage. So that's 4 or 5 a week on average based on their positions. And that's kind of a typical advisor that probably has 200, 250 kind of unique positions in their book.
250 unique positions. Okay. So let's talk about what the most popular or biggest issues came down to when it came to material significant changes. Like, what were the ones that really stood out?
Yeah. I mean, when you look at kind of industry trends, I'd say the last year when we've been closely monitoring it, kind of looks like any other year. Risk, some went up, some went down. So it wasn't like the industry is moving or the fund managers are taking their products in a different or dangerous place, if you want to think about it from that perspective. But it's really just the evolving change. So things like investment style shift or drift as measured by, some sort of an aggregate score like a CIFS category, historical performance numbers and how that affects a risk rating. Those tend to be kind of the key indicators to take a look at that. And typically, the industry is, as a whole, fairly stable, right? So the significant change is when you're able to boil it down to a handful of kind of areas to monitor and your book, it now becomes really just a handful. Very, very rarely, if we looked at those changes, were there these massive, I'll say catastrophic almost changes in a particular product, but they were shifts. So something went from a medium risk rating to a medium high. Well, that's significant. Advisors should consider that. But like I said, you've got 4 or 5 of those things happening a week, the majority of which are MER changes. And so very quickly, you can look at the magnitude of that change. And according to kind of a company policy to say, at this point, I need to take action if it's gone up by X number of basis points or not.
Fair enough. So that's being left to them. So bottom line is you're arming them with that. All right. So talk to me about how implementation's gone.
Sorry, say that again.
Talk to me about how implementation's gone in general.
Oh, it's a fairly streamlined process because the beauty of this is it's working with industry data. The only, I'll say, client-specific thing here is your position file. Mm-hmm. So once we feed in a position file, it's pretty much turnkey for monitoring, which is industry-wide, and then the filtering, which is position specific. So clients, I run a small assessment piece where I can do within a couple of weeks, I can assess a sampling of your advisors and kind of do a simulation of the past year of changes. And similarly, onboarding is we measure that in weeks rather than it's not a big lift.
So that's you pushing the data down to people and giving them what to look at. You have any kind of data or support on the actual usage of that, and any kind of data regarding what the impact of this has been?
Yeah, it's a little early on that. We're starting. We're keeping an eye on it. Nothing to really, at least on the monitoring side, to know how big a change that's happening. Certainly at the dealer level, our clients are using this to manage their shelf and to disseminate data. So we've got activity information. Is it moving the needle on the change side? Not so sure yet. The second area that I mentioned, the CFRs and Reg BI had a change, was on the product recommendation and product comparison side.
Yeah.
Again, really early days, but that's a system that's measuring advisor behavior. And there we're starting to see some early changes where when an advisor is presented with kind of a relative comparison, things do move slowly, and we're starting to see a trend in making recommendations of products that stack up, I'll say, more favorably to their peers over time.
Fair enough. I mean, at the end of the day, it's the dealer's job to enforce with their advisors, right? So that data might not necessarily be fully supported back to you. So there was some may not be provided back to you. So at the end of the day, I'm very curious to see if there was any if we ever get our hands on aggregate data on how many advisors actually did what they were supposed to versus got penalized. I guess the regulators will put that out in the future.
Yeah, we will. We'll actually probably start seeing some of that regulatory action this year. I think 2022 was a bit of a pass or more of an assessment of things. But I think regulators on both sides of the border, Canada and the US, are looking at Reg BI and CFR as key priorities in their examinations. And I think how products are recommended, how these processes have been implemented are going to be all indication that they're going to be a big focus for this year.
Excellent. Okay, so that was on the basically material changes. What other areas were you working on altogether, or significant changes, pardon me?
Yeah. The other one really is on the product recommendation side and how to do that product comparison or consideration of alternatives.
Yeah.
So regulators are considering, how do I mitigate, or how do the rules mitigate this recommendation of a bias or a conflicted product, and so require this consideration of investment alternatives. Too often that's implemented with kind of, I'll say, this head-to-head comparison. I think of my iPhone purchasing process where you select the two models and you do your feature comparison down 3 pages of data points and say, I want the Pro or something like that. And so too often it's a subjective process where, a rep will pick 2 products and do the comparison and say, I choose this one. And that's where the approach we've taken, again, very much data-based, to say, let's use some key product data points to group like products, and then a standard way of assessing them. So instead of individually, they're compared in aggregate. So at a click of a button, an advisor will see, how does this product stack up to its peers relative to cost, risk, and performance, historical performance?
Yeah. I mean, it's unfortunate we're still having, in the end of the day, we have to rely on historicals to some degree, but it's only so far that goes. I mean, my concern, it's interesting. I think, your concern is to provide those tools. My concern is people shooting an arrow and then drawing a bullseye around it. I found a lot of conversations around that was like, well, I use this. Well, why? I'm like, well, okay, I like them, but I'll come up with some reason as to why I'm using them. It's just like that. Come on. I mean, that stuff will filter itself out over time. I mean, frankly, this is not, again, I keep saying it from the advisor's perspective, this is not hard. Have a documented process, right? I recently, for example, had these product comparison inquiries happen from my compliance department, and they're like, "Oh, basically, you put this client in this thing. Well, what was the basis for it? What was the basis for comparison? What did you compare them to?" And it was simple. Like, I already come out. Like, here's my portfolio management process document. There you go. Here's our standards for comparison, where we took a simple example of, look, if I'm going to buy this type of portfolio, what's the ETF equivalent to it at a passive rate? What is a major mutual fund company, big independent, and what is a major bank's product? It's similar. So I looked at that and said, okay, between those three, I've got like a big name, three big names that it's a very good chance that you try to get the same thing. There's a good chance that those people can't capture a significant part of that market again, that product comparison. And at the end of I ran this by my chief compliance officer, and it's like, look, you're fine. Like, you've got a methodology. Right? It's those who don't have a methodology that's a concern, right? So I know that's not your issue. You just give the tools in order to perform that, and that's been valuable, because I have been able to go into compliance systems and do those comparisons against the ones that are relevant and document that at all, which is something we should be doing regardless.
Right, and I think that documentation piece is the key. Right? Whether you're doing it manually or using technology, it's making sure you capture it. And certainly a theme we've heard from the U.S. regulators is, in that documentation, that question of how can you demonstrate not only that you've done something, but that this recommendation is in the client's best interest. Yep. And that's a really slippery one. So it's not about, this is a good product, this is the best one. It's, why is it in their best interest and not yours? And that's it's hard to find the words for that. And I think,
if you're not using proprietary funds, it's easier, right?
Yeah,
there's an inherent conflict there, right? So that entire piece too. I think it also just depends on how you run your business. One thing I said previously is, anyone who just basically buys nothing but passive indexes has an easy time, because it's like, okay, I have this one Canadian or US ETF. Here's a Morningstar report against every other Canadian or US, like that exposure that I'm looking for. Here's how it stacks up. It's the cheapest in the category, for example, or it's close to the cheapest in the category. Done. right? Like, it's a lot easier when you start getting into the subjectivity of things, like when you really start going to the rabbit hole, like alternatives and how hard it is to do product comparisons in that regard, because performance doesn't tell you squat, because it's hard to really find apples to apples comparisons in those regards. It's a lot harder to justify your existence, or not your existence, but your actions.
Right. And I think the other key part, going back to our earlier conversation around principles based, it's not that there's a right or a best product. It's almost more about the guardrails to say, let's avoid as much as possible recommending products that are kind of clearly not in the category of good, suitable, best, better. But it's not like there's a drive, a formula that's going to get you the right product from a regulatory perspective.
Yeah, it's not like, it's some of the feedback I heard early on was advice like, well, they're going to, regulators are going to restrict me on what I can buy. It's got to be the cheapest thing every time. It's like, no, it doesn't. But if it's poor performing and more expensive, and then something that looks just like it, you got some explaining to do.
Right. And I think that's the shift. It's not like there are kind of your hands are tied as an advisor to make those conversations. I think professional judgment is clearly there. It's about providing enough context to say, when you use that professional judgment, do you know if there are any flags associated with that? And if there are, be prepared to or document your justification relative to those flags.
And here's the thing about this. This is also the old, an ounce of pain, an ounce of prevention is better than a pound of pain. The reality is that if you were hauled into court, right, these are baseline questions that would be asked. Why this? Why not that? Well, we had an expert witness take a look at your portfolio, and we found that you're using something that is basically in the top quartile of cost compared to its peers. Why that? Right? Like, you're going to be put on the spot at some point anyway. So having this all thought through and implemented and documented, it's really just forcing the industry into greater professionalism and systematic practice, but also just covering our butts, quite honestly.
Yeah. And I think the data around that to start seeing trends and behavior and identify outliers, while you could always have done that, I think that data will be more readily accessible, first of all, to the supervision function within a dealer, but then to the regulators and the examiners too.
100%. The data's sources for some of this stuff have been there for a long time, right? Like they've been well weathered and whatnot. But it's more so, you've had to come in and take this existing pool of data and data streams that constantly get updated and filter them and create that mechanism for just getting to the succinct thing in this giant pile of straw and finding that needle that needed to be taken out. So it's no small task, quite honestly. Legitimately, how many 2,000 changes? How many points of data are you tracking at this point as part of this exercise?
Yeah, it's millions. Like we did a bit of a fun calculation that said for that advisor product comparison task, an advisor has to contemplate or consider 1 million data points a day, right, to get through her day if she's making 6 recommendations a day. And that's just looking at 5 data points and how big your shelf is and all that stuff. And it's not the task of looking at this stuff, but it's a mastery, right? Because this is really about proficiency and mastery before you're making a recommendation, and that's insane when you think of that volume. Yeah. So,
and in practice, it's said per day, basically it's said per day, but in practice, right, simply doing kind of like quarterly or semi-annual kind of summaries and audits to make sure you're still in the right position and just keeping your ear to the ground over what are the changes, what new products are coming on there, but having that filtered out and given to you in a digestible way so you're not getting crushed by those millions of data points, that is completely feasible. It's just a matter of the system and setup, which of course you facilitate.
It is. And you use that analogy of, finding that needle in the haystack. And I think that has been really our focus to say, in the CFR and the Reg BI world, how do we deliver needles instead of a haystack that's got needles and tools to help you find the needles? We'll find the needles for you and bring them to your attention when you need them.
Yep. There's a lot, there's just so much going on there. It's okay. So those two areas, product comparison, that's natural. Those two buttress into each other a lot. So basically to date, you've got at least your first implementations rolled out. Everybody got past the finish line, hopefully, in order to meet the regulatory requirements. Where do you see the development of this going, especially in terms of your product development? Like, how do you see that evolving in the next little while?
Yeah, I'd say there's 2 primary areas. One, evolution of product comparison, I think, will be seeing the data roll in And once we see trends, how our behaviors or how our behaviors being affected, how do we move that needle further? I think that's going to be one evolution point. And the second one is an emerging theme around account selection and recommendations. So very little attention is being paid to that in the early days, but it's coming up as a theme both in Reg BI and CFR. There's been some recent headlines that said they want to start looking at, the selection of accounts. Is it a fee for service? Is it a commission-based account?
Oh, yes. Well, that's been a real issue in regulatory spaces. Advisors flipping clients who are just like buying old investors, holding a couple of securities into fee-based accounts, and suddenly their costs just going through the roof.
Right. And so that's where the conversation around considering an investor's interests first or their best interest becomes a bit of a slippery slope. So not only is it a process check and balance, it's making sure you're documenting, again, capturing this information, assessing and analyzing the different options of account types and why this was in that investor's best interest. In particular, in the US, there's a rollover focus the Department of Labor. And that's one of those where you're typically moving an investor from a lower cost account structure to a higher cost one in exchange for a lot of offsetting services.
Well, and that's really the crux of it, right? It's not a fee for fee look at it. It's if you're a buy and hold investor and you move to a fee based account, but that came with comprehensive financial planning services and everything else that comes with it, that can very well be justified reasonably, right? As long as it was disclosed properly. And the same basic principle applies to rollovers from 401ks. What we're trying, the market's trying to avoid is the regulators trying to avoid is someone being taken out of a very low cost environment, getting no upside and just suddenly paying 5x that amount.
Right. And I think that's where I think the future has taken us there. And it's not a distant future. It's like 2023, where some of the rubber will hit the road on account selection. And just from a product standpoint, we're starting to really extend our product into all these different, call them best interest activities that just need to be tracked, need a framework for determining and then documenting these decisions.
It's interesting because and I've written articles on this as well. On this issue is that you're talking about like the KYP and product specific stuff. There's also the know your client expansion in terms of being able to properly risk assess them. And unfortunately, my frustrations have been with conversations is people can't even define the terms. Tolerance, capacity profiles, all that properly. They just intermix them into one. And it'll be interesting to see how you guys take that data, validate it, and basically connect the two worlds together, right? Because I think in an ideal world, we have the same yardstick, right? We have the same metric for risk within the profiling that we do in the product comparison world and the product monitoring world, so that when someone comes out as, let's just use a risk number of like 75, that their portfolio is, at 75. It's measuring the same thing. It's not just measuring an amorphous number. And I think we're from what I've seen in implementations, at least in this country, we are a long way from that at this point because a lot of those questionnaires are based on nonsense. But it is what it is. So yeah, I think you're going to have an entire treasure trove of data there to also say like, hey, is this account level data actually matching up with the KYC stuff properly, and is that even valid? Right.
Yeah. No, definitely. I think that's certainly the direction we're headed as an industry too.
Yeah, absolutely. So, that was a lot of change in a short period of time. I say short with tongue in cheek because everybody got lots of warning. But of course, implementation always waits until 3 months beforehand. Like, oh, we can't meet this deadline. So I'm sure right now your clients must all be kind of like, okay, that's over. Are they and we're in the refining process now? Do you feel like they feel like they've gotten through the actual first surge of this all, or do you feel like there's still many of them playing catch up at this point?
Honestly, I think there's still a lot of catch up to be played. That assessing the impact on the advisor, I think was not really well done. Certainly industry wide, but then firm by firm. So some firms have said, yeah, we're covered. We put out a process. Our documentation's in place. This is really, call it practice management 101. So we're all good. And I think as they're looking closer, the burden that landed intentionally or unintentionally on advisors, I think they're feeling some pushback. They certainly did early in 22 and are looking for ways to streamline that. So, our advisor alerts was part of that. Say, okay, we got to help you get to the end point here and without adding all that burden.
Yeah, I think that's also just for some dealers I'll speak about. It's a mindset issue. Like the advisor is typically been historically the one who gets the most work dumped on them when this stuff happens at the end, right? Like at the end, and there's work that has to be done at that level, but to not think through the advisor experience and how to make this a manageable experience is a gross failure of management. Like that has to be a primary concern of, okay, you've got these criteria to hit. How do we streamline this to make it A, valid and effective, to make you better altogether, but B, also not overly time consuming and with the minimal amount of friction. And too often it's just like, you got a problem? Here's a bunch of tools, knock yourself out. And it's just like, wait a minute, you just gave a bunch of really busy people more work. What do you think the reaction is going to be?
Yeah. And especially if a huge chunk of that work is figuring out what to do or sifting through data to find the meaningful stuff, then it becomes a non-starter, right? Yeah. And so that's what we've seen in a few cases where advisor adoption or compliance isn't quite where you'd like it to be. It's not as frequent as you'd like it to be because the way it's being pushed or delegated to an advisor is kind of not in bite-sized actionable chunks. It's required a bit more assessment.
Or in workflows, right? Like that's the other thing, right? Theoretically, if someone got a link that says, here's your workflow to go through to verify that these holdings are fine, and you actually went through a step-by-step process that was guided, and at the end of it, you made a change or you kept it the same, but you also documented it, ta-da, right? Versus, like what product, you can use whatever product comparison tool you want on the side, but this is the reporting tool for aggregating it all, and you are obligated, and here's another tool for something else, and you're obligated to do it before the end of now. Right. It's like, I get it. I think I would say my only message to dealers listening is think more about the curation of the experience for the advisor when it comes to that. And and this is solvable. I've whiteboarded solutions like this before. It's just a matter of actually thinking through, not just dumping work. It's basically caring about making that workflow as good as possible. So, Dave, thanks so much for your time on this. This is great. I mean, I think this is continuing to emerge. I'll be very interested to see a couple of years once the data and the regulatory filings, the regulatory penalties and everything else is happening, just how effective this was. But I think in general, without companies like yours, we would have been crushed by the requirements.
Yeah, no, great speaking with you again, Jason. I really appreciated the time this morning.
Yeah, pleasure. Take care.
Okay, thanks. Bye.
So that was this week's episode of FinTech Impact. Hope you enjoyed it. And again, if you're an advisor going through all this, just think through how you're doing it. If you're a dealer, think through how your advisors can have their pain alleviated. And if you're a technology provider, think about helping them bundle it, because this is still the early innings, and frankly, we can make it a lot better. But nevertheless, the winner in this is the consumer, who basically hopefully gets a higher standard of care. As always, if you enjoy this podcast, please leave a review at Apple Podcasts, SoundCloud, Stitcher, Spotify, or wherever you get your podcasts. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at jasonpereira.ca.